Welcome to the Deep Dive, where we tear apart earnings calls to find the real story behind the numbers. Today we're looking at Lithia Motors, ticker LAD, and their Q3 2025 results. And this one is, it's a fascinating case of a company that seems to be living in two different realities at once.
That's the perfect way to put it. It's the central tension we have to unpack for you. Because on one hand, you have management just delivering an absolute masterclass, record financial beats. But on the other hand, the market just sort of shrugged. The stock was choppy all day on high volume and actually closed down 1% or 2%.
So that's our mission today. We have this huge disconnect. You've got record revenue, record EPS, an aggressive plan to buy back stock, and yet the market is skeptical. So we're going to dissect the story management told and figure out if Wall Street is missing the point or if there's something else going on under the surface.
Let's just start with the headline numbers, because they were, frankly, stellar. Total revenue hit $9.7 billion. That's up 5% year over year.
And that beat expectations, right?
Oh, yeah. Comfortably beat what analysts were looking for.
Okay. And the bottom line was where they really popped. Adjusted EPS, earnings per share, came in at $9.50.
Which wasn't just a beat. It was a 17% jump year over year. They blew past the consensus forecast by about 80 cents. So by any normal metric, these are just outstanding results.
They really are. And that's what makes the stock reaction so strange. You see that kind of performance, but the stock trades like it has a weight tied to it.
Exactly. And the high volume tells you people are paying attention, but the lack of any real buying pressure suggests there's a bigger skepticism about the whole industry. Management sounded, constructively bullish on the call, but the street was definitely leaning bearish.
All right, so let's unpack that operational engine. If the overall mood for auto retail is kind of soft, where did LAD actually find the juice to generate these kinds of earnings?
It was all about a very deliberate and very successful shift into the highest margin parts of their business. So same-store revenue, which is a great way to measure organic growth, was up a really strong 7.7%.
And inside that number, the growth was really concentrated, wasn't it?
That's it. Two key areas. Used retail revenue shot up almost 12% year over year, 11.8%. And after-sales gross profit, that's your service and parts, was up a hefty 9.1%.
That after-sales number, that's the most defensive part of this whole business model. When new car sales slow down, that's your safety net. How are the margins looking in the service bay?
It's way more than a safety net now. It's a massive profit engine. After-sales margins expanded to 58.4%.
Wow.
Yeah, that's up 280 basis points year over year. And it wasn't a fluke. It was solid growth in both customer pay, which was up 9.2%, and warranty work up 10.8%. When your service margins are getting close to 60%, you're looking at an incredibly resilient part of the business.
Okay, but we have to talk about the elephant in the showroom. New vehicle margins. Everyone in this space is dealing with a return to normal after the crazy pandemic shortages. So what did gross profit per unit, the GPU, look like for LAD?
Right. GPU normalization is a real thing, and they weren't immune. Total vehicle GPU was $4,109. That's down about $200 year over year. New vehicle GPU was down a little bit from Q2, landing at $2,867.
But there was a split inside that number, wasn't there?
A fascinating one. Domestic brands actually saw their GPUs improve, which suggests they're managing inventory well. The weakest spot was luxury brands.
So they're basically using the after sales and used car profits to offset the squeeze on new cars. That only works if you keep your costs in check. What about SG&A leverage?
They showed some real discipline there. North America adjusted SG&A as a percentage of gross profit was flat compared to last quarter. It held at 64.8%.
That's key, because when your front-end margins are shrinking, just holding costs flat is a win.
It's a huge win. And they're trying to do more. They talked a lot about increasing productivity and simplifying their tech with this Pinewood AI rollout.
Okay, this brings us to the most exciting part of their story. Their massive success in used cars, specifically this value auto strategy. Used unit growth was up over 6%. So what exactly is value auto, and why is it their silver bullet?
Value auto is they're focused on cars that are 9 years old or older. And what's wild is management pointed out this isn't some tiny niche. It makes up 63% of the entire used car market in the country. It's the deep, affordable end of the pool.
and they are just crushing it in that space.
Yeah.
Their value auto sales specifically saw a 22.3% unit increase year over year.
They are. And this is where you really have to slow down and look at the economics because it's so counterintuitive. You'd think selling a $10,000 car would have razor-thin margins, but LAD's results show the exact opposite. They've perfected the whole process for these older cars, and it turns them into these high-velocity, high-return assets. The annualized cash-on-cash return for the value auto segment is nearly 130%.
Wait, say that again? 130% cash on cash?
Right.
Just so the listener is clear, that's a measure of how fast you get your money back on an investment to reinvest it. How does that compare to, say, a newer used car?
It completely blows it out of the water. They're certified and core, so newer used cars, their returns are under 50% annualized. So this value auto segment is spitting out cash 2.5 times faster than the rest of the business. And it's doing it with an almost 16% gross margin.
That sounds like a pure arbitrage. But that only works if you can buy the cars right. So much of this seems to come down to how they source their inventory. They're not just going to the auctions.
That is the whole game. That's their moat.
Yeah.
In Q3, they reported that 74% of their used car inventory came directly from consumers, either trade-ins or just buying cars from private sellers.
74%. That is a massive competitive advantage. You cut out the middleman, you cut out the auction fees.
Exactly. Management estimates that gives them about a $1,000 cost advantage per car over the used-only retailers, the big online guys who have to live and die by the auction market.
So that 130% return, how durable is that? If the money's that good, won't competitors just flood into the 9-year-old and up market and kill the arbitrage?
That's the million-dollar question, isn't it? Management seems really confident that their scale and their service network give them a durable edge for now. Let's calling this an inflection point, because even with this growth, they have less than 2% of the total used market. They think that double-digit growth has just started.
And that conviction is also backed up by the growth of their finance arm, Driveway Finance Corporation, or DFC.
Yeah, DFC had a great quarter. They hit their 15% penetration rate goal way ahead of schedule. It kicked in $19 million to financing income, so it's becoming a really stable, recurring revenue stream. But are they taking on bad debt to get there? What does the credit quality look like?
It looks really strong, actually. The net interest margin was 4.6%, which is up 70 basis points. They're managing over $4.5 billion in receivables, and the key thing is delinquency rates were actually down year over year. So DFC is scaling, but it's scaling profitably and safely.
Okay, let's touch on their classic growth model, M&A. Buying up other dealerships. What's the pipeline look like?
The M&A flywheel is still spinning. They reiterated their $2 billion acquisition revenue target for 2025. They bought 3 stores in the Southeast in Q3, which adds about $220 million in annualized revenue.
And finally, the ultimate sign of management's conviction. The capital returns. They are screaming to the market that their stock is cheap.
They are putting their money where their mouth is, big time. Management said very clearly they think the stock is trading at a meaningful discount. And then they went out and bought back 5.1% of their entire company in 1 quarter. And the most telling number of all, the average price they paid for those shares was right around $312.
$312. That's management planting a flag. They're basically telling you, at this price, we think our own stock is the best investment we can possibly make.
It's a huge signal, a very powerful statement of confidence.
Okay, so let's recap. We have record beats, a high-octane value auto engine, a safely scaling finance arm, and management basically setting a $312 floor with buybacks.
Yeah.
So why was the market so nervous? Let's get into the headwinds.
Right. There were 2 main clouds the market was focused on. First was their UK operation. It's a smaller piece of the business, maybe 10% of revenue, but it got hit with some margin pressure.
Right.
Regulatory changes, specifically an increase in labor costs that had a $20 million impact in the quarter. So it wasn't a demand problem. It was a structural cost increase.
And how are they fighting back against that?
By doing the same thing they do in the U.S., pushing more into used cars and after-sales. But the really interesting move is that they're adding Chinese car brands, both gas and electric. They should have almost a dozen of those stores by the end of the year, which lets them adapt really quickly to market shifts.
Okay, and the second, probably bigger cloud, is the whole EV transition. How did that play out for them in Q3?
Electrified vehicle sales were a huge part of their new car mix, 43%. But that was driven by a massive spike in leasing. Almost 40% of new cars were leased.
Why the big lease push?
It was all about maximizing the $7,500 federal credit before it expired. Leasing was the easiest way for the customer to get that incentive.
That makes sense to move metal, but it usually means thinner margins on the front end, right?
Yeah.
Did they take a hit on GPU for those sales?
They did. Those sales had lower GPUs. But management argued it was a great long-term move. First, they cleared out a lot of older first-gen EV inventory. Second, they're stealing Tesla customers who are frustrated with Tesla's service network.
And the really big prize is the lease returns. They're essentially building their own pipeline of high-quality, 2-year-old used EVs for 2027.
That's the payoff. They get first dibs on the best used EV inventory, which feeds their whole used car machine. Management is just very confident that their overall model is on track to deliver their long-term target, which is $2 of ETS for every billion in revenue.
All right, that brings us to our final segment. We take management's conviction and spin it into an outrageous but plausible trade idea. And just to be crystal clear, this is not financial advice.
The whole thesis here is based on what management did this quarter. They bought back 5.1% of the company in 3 months. I mean, if you do the math, if they kept that pace up, they could buy back the entire company in about 5 years. They are the ultimate buyer of last resort, and they've shown their hand with that $312 price.
So you need a trade that has a long runway, something that lets that EPS compounding work its magic.
Exactly. So the idea is a deep-in-the-money, long-dated leaps call option. For anyone unfamiliar, LEPS are just long-term options. So you're not betting on a short-term pop. You're giving the thesis time to play out, let's say, a January 2027 expiration.
And the bet is simply that the combination of the M&A flywheel and these relentless buybacks will shrink the share count so much that EPS will have to compound higher. And that eventually forces the market to re-rate the stock way above 350.
It's a leveraged bet on management's confidence. If they're right and their business is, quote, a rocket launching into space, then the market eventually has to catch up to their valuation.
A remarkable pitch based on some truly remarkable execution. Okay, to summarize this whole deep dive, LAD delivered record results, and they did it by mastering the economics of old cars with their value auto segment and leaning on their after-sales engine. DSC is growing safely, and their capital allocation is about as aggressive as it gets with that $312 buyback price as an anchor.
So the final provocative thought to leave you with is this. LAD proved that the biggest profits might not be in the shiniest new cars, but in perfecting the process for the oldest, most affordable ones. Given that value auto is 63% of the used market, the real question is, how long can that 130% cash-on-cash return last before everyone else tries to copy their playbook?
We'll leave you to ponder that competitive moat. Thanks for joining the deep dive.